Your life insurance agent told you whole life was a smart investment. What they did not tell you is that for every dollar you paid, they kept most of it in fees. You have been paying for protection your family may never collect. This is not an accident, it is by design, and it is completely legal. By the end of this video, you will know exactly which life insurance policy is worth your money and which one is making someone else rich. You will also know the single question to ask before you sign anything. This could save your family tens of thousands of dollars. Stay with me. Term life insurance is the simple one. You pay a monthly premium. If you die during the term, your family gets a lump sum. That is it. There is nothing else buried inside it. A healthy 35-year-old can get $500,000 of coverage for around $25 a month. That is a 20-year policy. Think of it like renting an umbrella. You pay while you need it. When the rain stops, you stop paying. If nothing happens during the term, the policy ends. You paid for protection. You got it. No refund, no surprise fees, no confusion. Whole life insurance covers you for your entire life, not just a fixed term. It never expires as long as you keep paying. It also has something called a cash value component. A portion of every premium you pay goes into an account that grows over time. Sounds good so far. Here is where it gets expensive. That same $500,000 death benefit on a whole life policy costs $300 to $400 a month, not $25, $300. Think of it like buying a house when you only need a hotel room. You are paying for something permanent when your need is temporary. Agents pitch the cash value as a savings account. The money grows and you can borrow against it. That sounds useful. Here is the truth. In the first 10 years of a whole life policy, almost nothing goes into your cash value. The fees eat it. If you paid $3,600 in year one, your cash value might be $300. The rest paid commissions and administrative costs. When you borrow from your cash value, you pay interest on your own money. That interest goes back to the insurance company. And if you die with a loan outstanding, the company deducts it from the payout your family receives. A term life agent might earn $100 to $200 commission on a new policy. A whole life agent can earn $2,000 to $5,000 or more on the same coverage amount in the first year alone. That commission comes directly from your premiums. This is why whole life is pushed so aggressively. The agent who sold you whole life may be a good person with good intentions. The incentive structure of the product works against you. Mistake 1. Buying whole life to leave money to your children. A term policy plus a simple index fund investment beats whole life cash value in almost every scenario. If you invested the $300 monthly difference between whole life and term into a basic index fund over 20 years, you would likely have far more than any cash value payout. Mistake 2. Thinking you cannot switch policies. You can. You can replace a whole life policy with term life at almost any age. Yes, you will lose what you paid in, but you will stop losing going forward. Mistake 3. Confusing permanent coverage needs with investment goals. Insurance protects against risk. Investments build wealth. Mixing them together usually does both badly. If your family depends on your income right now, the answer is almost always term life. Pick a 20 or 30-year term. Get 10 to 12 times your annual income in coverage. That is the one question to ask yourself. Does anyone depend on my income right now? If yes, buy term. Keep it simple. Next week we are covering full coverage car insurance. Most people think they have it. Most people are partially wrong. That one catches drivers completely off guard. Subscribe so you do not miss it. Before we wrap up, This video is for educational purposes only and is not financial or insurance advice. Every insurance policy is different. Always read your own policy documents and speak with a licensed insurance professional before making any decisions.